Now, back with Ticky Fullerton.
Welcome back. We're just talking to BlackRock's Craig Vardy a moment ago about the rather high consumer credit we now have in this country. My next guest, Roger Montgomery, is actually getting rather concerned about credit generally and globally. The founder and chief investment officer of Montgomery Investment Management joins me at the desk.
Hi, Ticky.
Roger, hello. What particularly concerns you on a global level now?
Well, it's a combination of two things. It's the volume of debt outstanding combined with the fact that liquidity is now being pulled from the market. So
we're talking personal debt, corporate debt, national debt?
Corporate debt, national debt, particularly in emerging markets and in the high-yield space in the United States. Let's just take a step back from all of that and just talk about what's happened and where we are today. What's happened is, since the GFC, interest rates were brought down to zero, then long bond rates were brought down as low as they possibly could be through quantitative easing. What was the purpose of that? The purpose of that, pretty simple, to get people not saving, to stop people saving, discourage saving, and encourage investment. That produces asset inflation, the wealth effect, people feel wealthier, and so on. What's actually happened now is that there's more debt in many spaces, be it municipal debt in the United States, or whether it's student loan debt in the US, or subprime auto loans, or emerging market credit. There's more of it now than there was prior to the GFC.
It is extraordinary.
And interest rates are zero.
Yes.
Right?
I was going to say, one of the things that hit me was our infrastructure business sectors trying to do business over in the US, and the municipal bond market is one of their main obstacles.
Yes. Yeah, correct. So there's something like $274 trillion of outstanding debt at the moment. And the biggest growth since the GFC has actually been in emerging market debt. So when interest rates are zero, everyone's trying to find a high yield. Where do they go? They go into bond funds. And they couldn't normally, you and I couldn't normally invest in emerging market bonds. That would be almost impossible to do. We'd have to buy individual bonds and then manage all the foreign currency risk. So along comes ETFs, and hey presto, anyone can buy emerging market debt. And so a lot of money's gone into that. Now, the problem is...
That's bubbling out now.
Well, I think there's a bubble in that space. And it's happening at the same time. So at the same time that we've got maximum retail participation, we've got interest rates now starting to go up. And that is a real issue, because at the same time interest rates are going up, liquidity is being pulled from the market. And we know, bottom line in Australia, for example, house prices, it's all about liquidity. It's about credit extension. It's about the extent to which banks are willing to lend money to people to buy property.
What you're saying is really that, and this has happened so often before, that at the end of the cycle, when it all goes to custard, it's actually the retail investors that are the last people holding them.
And I do worry about emerging market ETFs, because it's you know, we've had very low levels of volatility and very steady gains in these markets, and that's a function of the fact that billions of dollars, if not trillions of dollars, have been flowing in, billions of dollars been flowing into these ETFs. And so, of course, the ETF, the liquidity in the market that the ETF is ultimately investing in, it's not as liquid as the ETF itself. Now, when the market's going up, it's all well and good, money's flowing in, and they can feed out that money into the market and over time, and it's just a very smooth rise. So up until January this year, we saw record low levels of volatility. But what happens when people want to leave? What happens when the liquidity or the velocity of the ETF is higher than the velocity of the underlying securities, be it equity ETFs or bond ETFs? And so I'm very concerned that when liquidity is abundant, it doesn't prevent the market crashing, but we haven't seen a market crash. But when liquidity is being pulled, the smallest inflection in a fundamental can cause a very big ruction in underlying markets.
Wow, that sounds quite worrying, particularly for retail. Roger Montgomery, thank you so much.
A pleasure, Ticky.
Well, let's finish with